Financial risk perception refers to how individuals interpret and evaluate uncertainty in financial decisions. Rather than being purely objective, risk perception is deeply rooted in mental processes shaped by psychology, experience, and environment. Research in behavioral economics and cognitive psychology shows that individuals often perceive risk through subjective mental frameworks, which can differ significantly from actual statistical risk. 2. What is risk perception? Risk perception is the way individuals interpret potential gains and losses, assess uncertainty and probability, emotionally react to possible outcomes. It is not just about facts, but about how those facts are mentally processed and experienced. 3. Cognitive foundations of risk perception. Heuristics, mental shortcuts. Individuals use simplified thinking strategies to evaluate complex risks. Examples include judging risk based on recent experiences, relying on easily recalled information. These shortcuts help decision-making but can lead to distortions. Framing effect. The way information is presented affects perception. A 90% success rate feels safer than a 10% failure rate, even if they are identical. Probability misjudgment. People often struggle to accurately assess probabilities, especially in uncertain or complex financial contexts. 4. Emotional foundations. Fear and anxiety. Negative emotions increase perceived risk, often leading to overly cautious behavior. Excitement and optimism. Positive emotions can reduce perceived risk, encouraging risk-taking. Loss aversion. Individuals tend to fear losses more than they value gains, amplifying perceived risk and potential losses. 5. Role of past experiences. Personal experiences strongly shape risk perception. Past financial losses increase sensitivity to risk. Previous success may lead to underestimating risk. These experiences create mental patterns that influence future decisions. 6. Social and cultural influences. Risk perception is also shaped by external factors. Family attitudes toward money and risk. Cultural norms regarding saving and investing. Peer behavior and social comparison. Individuals often adopt risk perceptions from their environment. 7. Cognitive biases affecting risk perception. Availability bias. Overestimating risks that are easily remembered. Overconfidence bias. Underestimating risks due to excessive self-belief. Anchoring. Relying heavily on initial information when evaluating risk. Herd behavior. Following others' actions rather than independent analysis. 8. The role of financial awareness. Financial awareness helps correct distorted risk perception by providing accurate information about probabilities and outcomes, encouraging objective evaluation, reducing emotional influence, improving long-term thinking. It allows individuals to distinguish between perceived risk and actual risk. 9. Consequences of distorted risk perception. Avoiding beneficial opportunities. Taking excessive or poorly calculated risks. Inconsistent financial decisions. Increased stress and uncertainty. Understanding mental origins helps reduce these negative effects. 10. Strategies to improve risk perception. Increase financial literacy. Understanding basic financial concepts improves risk evaluation. Use data and analysis. Rely on objective information rather than intuition alone. Reflect on emotional responses. Recognize how fear or excitement influences decisions. Diversify decisions. Avoid over-reliance on a single judgment or perspective. Slow down decision-making. Allow time for thoughtful analysis, especially in uncertain situations. 11. Conclusion. Financial risk perception is shaped by a complex interaction of cognitive processes, emotions, past experiences, and social influences. It is not purely rational, but deeply rooted in mental frameworks that guide how individuals interpret uncertainty. By increasing financial awareness and understanding these mental origins, individuals can develop a more balanced and accurate perception of risk, leading to better decision-making, reduced bias, and improved long-term financial outcomes.